Ahead and get started. So like I said, thank you everybody for joining us. My name is Kyle Kite with Klaas Financial, and we also have Melissa Wanger, another advisor in our office on the call as well. And we want to give a special thanks to all of our Members Alliance members that have joined us tonight. We've had a great relationship with Members Alliance for a number of years, and so we're very happy to continue serving their members. And the goal tonight, guys, is just to give you some educational things to think about as far as you're looking at retirement and things like that. You know, it's never too early to start planning for retirement. Some people like to wait until the last minute, and that's Melissa and I's most stressful appointments is when they come in and say, "Kyle, I'm retiring on Friday," and I say, "Okay, I hope you've saved enough," because there's not a lot of planning we can do at this point. It's just the numbers are what they are, and we'll do the best we can. So by starting to plan early, you're definitely doing yourself a huge favor, and it gives us time to make adjustments if we need to. And obviously these plans, retirement plans, are not set in stone, and they're going to continually evolve even throughout retirement as things change. Grandkids move away, or you get new grandkids and things like that. So things can continue to change. So like I said, tonight is mostly educational. We're going to cover a lot, guys, and we're going to kind of gloss over some big topics. But if you have more in-depth questions, don't be afraid to let us know. We'll try to answer them. And then we are always open for one-on-one, questions after the call, or shoot us an email or anything like that. We'll be happy to answer what we can. So what we'll focus on mainly, like I said, is retirement planning, because that is our specialty. So at Klaas Financial here, we have been in business for 44 years, about 44 and a half. We're getting close to 45 already. And our specialty is retirement planning, as I said. So we are what they call an independent wealth management firm, which means we don't have a bank or anybody like that tells us we have to sell certain mutual funds or anything like that. So we can truly use the world of investments for our clients. And then that just gives us more options. And like I said, we specialize in retirement planning. So the planning piece is what we like to focus on. Investments, as we'll definitely talk about, investments are a huge part of retirement, but you can accomplish a lot more goals by making sure you have a good plan in place, because as we all know, we can't control investment returns, even though we would all love to. So more the planning piece of, hey, this is what, the investments have returned over time. So this is what we have to plan for. And then, as I said, we're going to make some tweaks as we go along as well. So our company here, we have 3 divisions. For those of you that don't know, we have 2 divisions that we primarily work with individuals and families through. So one of them is called KIP, or Klaas Investment Portfolios. So in that division, that is kind of your traditional fee-based asset management, they call it, where that's for people that want to, turn over their 401k or IRA because they don't like to do investing on their own and just want a professional to handle everything for them. That would be our KIP division. And then we also have a Klaas 360 division, which is what they call a fee-for-service division. So in that division, it's more for people that are do-it-yourselfers that like to, have their own whatever Vanguard accounts or TD accounts. They like to do a little bit of their own trading, but they also want a professional's opinion occasionally. And in that division, we can actually charge an hourly fee. So when people ask if Klaas Financial has a minimum, not really. We can actually help anybody. It just depends on how you want to utilize our services and what kind of guidance you're looking for from us. So with that, we will jump into the presentation. Anything you want to add, Melissa?
Nope, I think you did great, Kyle. Thank you.
Okay, so let me share my screen here. Give me 1 second. Let's see, I should actually move that over. Let's do that. Okay, can we see that?
There it goes.
Okay, perfect. Got through that. Okay. So this is kind of a breakdown of what we're going to be covering, different sections throughout the presentation tonight. So the first one here is what we call the Tale of Two Retirements. And then we'll get into healthcare and Social Security. And then we'll talk a little bit on inflation and spending, and then some strategies for retirement living. What we'll also cover a little bit, guys, is some estate planning topics, and also we'll talk a little bit about long-term care, things like that. We are not attorneys, we are not accountants, so we don't file individual tax returns, we don't actually write wills or trusts or anything like that, but we definitely, steer clients to what makes sense for them, what they need, so that way they don't have, get steered into a trust or into an insurance product that they don't really need. So we have enough understanding about all the different pieces of the retirement plan to kind of give you some guidance here. So the first one is the tale of two retirements. So this is where we're going to get a little bit heavy into investments. So everybody has heard the term bull market or bear market, and what that means for the stock market. So a bull market, the reason it's called a bull market, back in business school they taught us this, is because a bull, when it attacks, it moves its head up. So when you think of a bull market, you think of the stock market going up. So if you were fortunate enough to retire in 1990-ish, 1991 here in this scenario, and you started with a portfolio of $500,000 on the left here, and you were pulling $70,000 a year off of that portfolio, you see that on the right there. If you do the math on that, that's about a 14% withdrawal rate. I don't know of any financial advisor that would be comfortable with people pulling a 14% withdrawal rate for a long period of time. However, if you retire at the right time and you retire in a very good market, which the 90s was one of the best markets we've had for a 10-year stretch, there was a joke back then that even a monkey could make money because it really didn't matter what you picked, it all was going up. So if you're fortunate enough to retire in a bear market or a bull market like that, you can see that you can actually start with $500,000, pull $70,000 a year, and you can increase that $70,000 a year by 3% inflation each year. And in this scenario, you'll see they actually never ran out of money and they get up over the $900,000 mark in their portfolio. So again, that's strictly because the stock market was doing so well for those 10 years. The other caveat to this illustration is that this is assuming you were invested in 100% US stocks, or some people know it as the S&P 500. So this is essentially, if you just bought the S&P 500 for those 10 years, you would have made, a significant gain in that. Again, not many advisors are going to tell you that you want to be in 100% US stocks as you enter retirement. And the reason for that is you never know what market you're going to be in. So if you take that exact same scenario, but take it the next 10 years, so from 2001 to 2010, that was known as the decade of zeros. It was actually, the market was essentially flat for those 10 years, which doesn't happen very often at all. So same scenario, you start with 500,000, you pull your 70,000 a year adjusted for inflation, and you'll see that you run out of money by the end of 2007 there, so mid 2007. So again, exact same stats, 100% stock just in the next 10-year time frame of the market, and you actually run out of money fairly quickly. So this is why, again, most advisors are not going to tell you to be in 100% stocks as you enter retirement, and most advisors are not going to tell you to pull 14% a year off of your portfolio either. So we'll get into some other strategies of how you can, what are safe withdrawal rates, how should you be invested in retirement, those types of things as we go along here tonight. Okay, so Melissa, you can do the healthcare and Social Security.
Yeah, go right ahead and go on to the next slide there. So, one of the questions, like Kyle said, if you're coming in on Monday telling us you're retiring on Friday, a lot of the questions we get is how much is it going to cost to retire? That's a question we can't really answer. Everybody's lifestyle is different, and understanding what your expenditures are, if you have any debt out there, or, how you want to retire, if you're the next door grandma and grandpa, or if you're world travelers, or, all that plays into that. So understanding that there's two factors is how much you're going to spend during retirement, but another big factor is how long you expect to live. And obviously no one has a crystal ball on that statistic, but, looking at here, 40% underestimate the actual average life expectancy. So the average person that lives to age 65, 84.3 for men and 86.6 for women is the life expectancy age. But of that, 25% of the people who make it to 65 will actually live till 90. And another 10% that make it to 90 are going to live to 95. So most we find is that you've either not estimated your expenditures correctly or potentially your life expectancy. I sit with clients all day long that, mom passed away at 80, so I'm not living past 81, but dad lived till 95. So we got to be accurate on our life expectancy in order to accurately calculate out how long we need our money to last, and then how much money we're going to spend during that time frame.
Mm-hmm.
Go ahead, Kyle. So the other big topic in our spending is how much things cost while we're spending that money. So the slide that you see here, the green line shows healthcare costs, and if they were to track the CPI, or the Consumer Price Index, versus what they actually did, which is the purple line. So as everybody knows, inflation is there. Inflation is kind of a little bit of a silent killer, but when it comes to healthcare, healthcare does not track on inflation. Healthcare has actually increased substantially faster than inflation does. And that's something to be aware of, because remember, as you're retiring, you're getting to an age where you might be using more healthcare and there might be more costs medically out there. So it's definitely a big thing to keep in the back of your head, whether you make sure that you've got proper healthcare coverage, you've got proper savings for healthcare expenses, as well as, you know, what could happen, long-term care, do we need to have different coverage out there for any healthcare needs that'll arise throughout your retirement. And then going directly with inflation, you'll see here on the left side is 1965 versus 2015. The costs of our goods and services and the products that we've bought, whether it be a new house, car, gas, has increased substantially larger than the actual average income if you divide them out. So remembering that inflation is something we need to really watch for and keep an eye out for as we look at our money. A lot of people want to just shove it under a mattress and say it's safe that way. Inflation is one reason it's not, because your dollar is actually going to be worth less as you get through retirement. And retirements nowadays we're seeing can be 20 or even 30 years long. And the cost of our goods and services at one point in time, 30 years later through retirement, could be substantially larger.
Mm-hmm.
This slide here is actually kind of interesting. So expectation versus reality, 67% of the people that are working expect to continue to receive some form of working pay once they get to retirement. A lot of them assume they'll pick up a part-time job, or they'll do something along the lines to make money. The reality is that only about 27% of retirees actually end up working during retirement. Whether that is you don't want to work anymore once you get to retirement, you don't like getting up early, or health concerns that come in that don't afford you the ability to work during retirement. And then as far as employer-sponsored retirement plans, your 401ks and such, 46% of people assume that that is going to be their regular retirement income. It's actually only about 19% make it the actual major source of their income. And conversely to that, 35% of people expect that Social Security will be their main source, when it actually ends up being 62% of people use Social Security as their major source. And this comes in really to planning. So when you're assuming that Social Security is not going to be your main source of income, you've got to really plan for that. But if you haven't planned appropriately, or you haven't put enough aside for retirement, that's where the reality kicks in, that you end up having Social Security as your main source of retirement income because you haven't saved aside enough, or been realistic with whether it's your timeline, life expectancy, or the expenditures that you're going to have throughout retirement.
I think we can talk a little bit about Social Security and Medicare on this slide too, Melissa. So as Melissa said, 35% of people expect that Social Security will be a major source, but it's actually 62% that it ends up working out for. So why this is important, this is, people tend to think that, oh, I'll get to retirement and it's just all going to work out. Well, in order to not have Social Security be your main source of income, it has to come from somewhere else. So it either has to come from either 401ks that you've been saving from, or it has to come from company pensions. And as all of you know, pensions are becoming harder and harder to come by. Companies are doing away with those big time. So what most people are left with is a 401k plan or something along those lines. For those of you that are in nonprofits, it's called a 403b. For schools, hospitals, things like that is typically a 403b. So we get this question all the time of, oh, my employer's not matching what I put into my retirement, so I'm not putting anything into it. Well, that's, not the way to think about it. It's your retirement. You want to retire at some point. You should be saving for it for yourself, whether an employer saves for you or not. It's you want to take care of yourself for sure. And when you get to Social Security, this is the big question. One of the big questions we help people with is, when should you actually take it? So there's actually a few, different ages to be aware of with regards to Social Security, and we'll tie it into Medicare as well. So some of you are aware that 62 is actually the youngest age that you can begin receiving Social Security. And if you take it at 62, however, there are some stipulations. You actually take a reduction in benefits from what your full retirement age would be. And then it will also, they put a limit on how much money you can make if you're taking it before that full retirement age. So 62 is the earliest. Most people's full retirement age now is between 66 and 67. So it could be 66 and 10 months, 66 and 8 months, something like that. But for most people now, it's between 66 and 67. So while that full retirement age is important, that has to do with, that's when your benefits are essentially 100% of what your earnings record is. Now, the good thing between 62 and 66 and all the way up to 70 actually is you get something called delayed retirement credits. So every year you do not take Social Security, it grows at 8% a year. So if you take it at 62 and your full retirement age is 66, you're actually only going to get somewhere around 72-ish% of your full retirement age benefit. And that's locked in for life, guys. So you're taking that smaller benefit and you're stuck with that no matter if you live to 95 or 80. It's all going to be the same. And the final age, full retirement age, like I said, is 66 to 67, and then the final age is 70. 70 is really as long as you would let it grow, because after age 70, you no longer get those delayed retirement credits of 8% a year. So typically people take it at 70 if they wait that long. So 70 is actually your maxed out benefit. So the joke I have with clients is that if you tell me the day you're going to die, this whole thing becomes a real simple math equation, right? We know how much you can take off your portfolio. We know when you should be taking out Social Security, all those types of things. So many people, when it comes to Social Security, look for like their break-even point, right? If I take it at 62 and save that money instead of spending it, how long does it take me to catch up and things like that, right? So there's some rough numbers. Everybody's individual number is actually different because you all have different amounts that you've earned over your years. So that's what determines your benefit and that kind of thing. So Social Security takes your highest 35 years of earnings. So some people have a misconception that it's like your last 5 years or something like that. It's actually your highest 35 years. So for many people, as you're working longer, your earlier years of work are falling off. So if you're, let's say, 65 years old, you've been working since you were 20, you're probably making more now at 65 than you were at age 20 because you're in higher paying positions and that kind of stuff. So every year that you continue to work, it actually, your Social Security benefit goes up, not only by the 8% for holding off, but also because your earnings record is changing too. So it's going to go up a little bit that way as well. So those are kind of the big things with Social Security. And now Medicare is separate. So many people get Social Security and Medicare tied together, but they're actually two separate things. So just because your full retirement age is 66 or 67, you're still eligible for Medicare at 65. So years ago, these all used to kind of line up where your full retirement age was 65, and that's when you could get onto Medicare as well. But that's changed. Like I said, they moved the full retirement age back. It's probably going to be continued to push back because, as we all know, you hear that, oh, Social Security is going broke and it's going to run out of money, this and that. That's actually not true. It's fully funded for the next number of years. I think it's through 2033 or something like that. It's 100% funded. And then even after that, it's still like 75% funded. So don't worry, especially for those of you that are getting closer to that 65, 66, 67. They're not going to change it on you right now. They may change it for your grandkids. They may have to wait till 72 to pull Social Security or something like that. But for those of you that have been paying in for a number of years, it's probably not gonna change too much. So again, if you look at for a break-even point on Social Security, it all depends on life expectancy, obviously. So what most people tend to find out is if you live past life expectancy, which as Melissa said on a few slides ago is about 82, 83 years old for people. If you live past life expectancy, you're actually better off waiting until 70 if you look at it strictly a mathematical perspective on it. And then if you pass away between, I think it's around age 76 and 82 or 83, whatever that number is, then you should take it at your full retirement age, which is again 66 or 67. And if you pass away before then, you should actually take it at 62. So again, it's all a guessing game of how long you're going to live and things like that as far as when you should pull it. It's a completely personal decision. Like I said, just because the math says if you live long enough, you should wait till 70. We don't have a ton of people that actually wait till 70 to start pulling it, because typically when you're 65, 66, those first couple of years of retirement, you've got your bucket list that you want to finish up and check off. So many people start pulling Social Security when they stop working, whether that's 65, 66, whatever it is. But if you're working with a retirement planner like us, we would help you calculate out exactly, what makes sense. How much are you, kind of giving up if you do take it now and live long enough and those types of things. But it's a completely personal decision. And there's really no right or wrong answer. And most people, they want the money, like I said, younger when you're healthy enough to use it. Who cares if I get an extra couple $100 a month when I'm 85 and not really out doing things or anything like that anymore. So.
Kyle, there's a question there if you want to.
Okay. I can't see it on my end. Do you want to read it out?
Yeah. Isn't there a max dollar amount per month one can get? Difference between 50,000 average or 250,000 average?
So there is a maximum benefit. I don't know what it is off the top of my head because you would have to make a really high amount of income for a number of years to get that maxed out. So I'm not sure exactly how high it is. That's a great question, but I don't know that answer off the top of my head. And then was there something else about 50 and 250?
Yeah, difference between 50,000 average or $250,000 average is that?
As far as income goes, I'm guessing.
That's what I'm guessing.
Yeah, so as you earn more, you're paying more into Social Security. So they use up to, I think they just changed it. It used to be 118,000 a year of income to get the max benefit for that year, but now I think it's actually up over 120. I think it's 120, 122, something like that. So if you're making, 200,000 a year, only 120 something of that is counting towards your maximum Social Security. So that's why there is a max amount of Social Security, is that they only count a certain amount of income from each person. They put a cap on what counts towards Social Security.
And another question that came in, and is there not also a cap on salary you can draw while still receiving Social Security? So yeah, that has to do with the age that you're pulling Social Security. Once you get to full retirement age, there is no cap. You can pull your Social Security as well as making as much income as you want. But if you pull your Social Security early, 62, 63, there is a cap on how much you can make per year of actual earned income. Kyle, is it 19 or 18,000 it went up to this year?
It's 18,000. It used to be 17.8, I think is the official number. So yeah, so when people ask, should I take it at 62? Our first question as advisors are you going to keep working? And if you are you going to make more than $18,000 a year? Because if you are going to make more than that, you don't lose benefits, they suspend benefits. So essentially they suspend it up until your full retirement age, and then they will pay out the suspended benefits at that time. So for most people, if you're not gonna make more than 18,000 a year, it's a non-issue. So even if you get a part-time job, whatever, delivering car parts or whatever it is, working at Hallmark, and you're going to stay under that 18,000 a year, then it doesn't impact your Social Security. It's only if you go over that roughly 18,000 a year in income. Yeah.
Great questions.
Great questions. Yeah. Okay. So we'll jump ahead. Okay. So this slide here, this is kind of what we were talking about in the beginning, where you showed the bull market retirement versus the bear market retirement. And how none of us can control the market. So, knowing when you retire, none of us can predict the future. So knowing what type of market you're, retiring into is obviously not a good strategy. So in this scenario, we're showing the difference between drawing out about 8% a year, which is that 80,000, that yellow line. So 8% a year, because 80,000 off of $1 million is about $80,000. You can see that if you do that, and this is adjusted for inflation. So with all of these income numbers, guys, it's kind of that they adjust them for inflation, which is the right thing to do. But Melissa and I's clients don't call us up on January 1st each year and tell me to send out an extra 3% for inflation that year or anything like that. So, but they illustrate them that way. So if you start out pulling 80,000 a year and you adjust it by 3% a year, this is assuming that you are only earning about 4% a year, I think is what the numbers are. You can see you run out of money in about 15 years. So most advisors are not going to be comfortable with clients pulling out, 8% a year for a long period of time, because we know that it could be sustainable if we're in a good market, but you just don't want to run the risk of running out of money. So that's why you'll hear, if you look at that green line up at the top, 40,000 a year is about 4% off of $1 million. So that's kind of why the rule of thumb you'll hear about how much you can take off of your portfolio is around 4%. Some will say 4 to 5%, somewhere in that range. And that's because, again, assuming you're invested conservatively in retirement, your accounts likely will make in the 4 to 5% if it's properly diversified, invested how it should be. That's kind of why you'll hear that. And there was actually a study done, I forget how many years ago, but somebody ran the numbers of like 100 years of market return and what was the rate that was sustainable through all those different time frames. And that number came out to be about 4%. So that's kind of why you'll hear that 4% number thrown out there for a sustainable withdrawal rate. So why that's important is, so many clients ask us, oh, how much do I need to retire, right? So, and our thing again is, it depends on your lifestyle. We have clients that, are used to living on hundreds of thousands of dollars each year, and that's the lifestyle they want to continue. Well, they're going to need a lot more to retire the way that they're used to living. We have other clients, that have, lived frugally and don't spend a whole lot of money. They may need nowhere near what those other people do. So a lot of the popular magazines out there, Money Magazine and things like that, they'll put out that $1 million bogey for people that think you have to have $1 million to retire. It's a good thing to have as far as a target. It tends to work out pretty well for people if you can hit that $1 million number. We don't have a whole lot of people that have $1 million that are struggling or not living the lifestyle they want to live, but it's definitely not a be all end all that you have to work until you get that $1 million, because all your portfolio is, guys, is a bucket of money that we're pulling money off of each year. So like in this scenario, pulling that $40,000 a year, but this doesn't take into account Social Security. This doesn't take into account if you have any pensions from employers or anything like that. So we have many people, that have an employer pension, and their pension is, $50,000, $60,000 a year. Then they get Social Security on top of that of another 20 or 30,000. So they really don't even use much of their portfolio that they save for all those years, because they have so much other things. But then you have other clients that maybe they were self-employed and didn't pay into as much into Social Security, or they don't have that nice pension and things like that. So they may need actually more than $1 million, because they're used to living a little higher lifestyle and need a little bigger nugget to pull off the money that they need. So the answer is, it really depends on what you're trying to do. And these withdrawal percentages can fluctuate as well, right? So 4% again is what they'll use for a long time frame. But as most of you know, you're probably not going to spend as much money at 85 or 87 as you are at 65 or 66, right? Eventually, you're going to check those trips off the bucket list, and there's not going to be a whole lot of places left to see. And maybe you've got grandkids that you like spending time with, and you're just comfortable in your little lifestyle, and it's reading books and things like that. It's not spending what you were 20 years ago. So these things are completely fluid and fluctuate. So.
Kyle, we got another couple of questions that come in.
Okay.
What is the impact on Social Security benefit amount if one is only 15 to 20 years of working out of the 35? So in other words, 10 to 15 of the years have a zero salary.
Mm-hmm. So that is going to impact your benefit, because again, they use your highest 35 years. So you're actually taking, zeros for those other, whatever it is, 15 or 20 years that you didn't have an income. But this is where the spousal benefit comes in too. So we have, many clients where maybe the husband was the worker and the wife stayed at home and raised the kids. So she actually didn't pay much into Social Security, or, she worked for years before they had kids, but then didn't go back to work, things like that, which is kind of the situation you're talking about. So when you get onto Social Security, you either pull your own or half of your spouse's, whichever is higher. So what that looks like is, let's say the husband worked, he had his 35 years in, and his Social Security benefit is, we'll say $2,000 a month to make the math easy. And the mom stayed home with the kids. Maybe she worked a little bit when she was younger, or maybe she went back after the kids were grown, but it was only for, 15, 20 years. So she doesn't have that full 35 years in. So let's say the husband's is $2,000 a month, and then the wife's is maybe $700 a month on her own record. So if she were to start that, she can actually get bumped up to half of the husband's. So it's what they call a spousal offset. So they would still give her $700 a month, but then she would get an offset of $300 a month to get it up to $1,000 a month. So if you have a non-working spouse or anything like that, it's either their own or half of their spouse's, whichever is the higher.
And then another one, if you have a pension that makes up 50% of your annual needed income, what would you recommend as a withdrawal rate if your portfolio is $1 million today? 4% seems low.
Mm-hmm. I mean, it's hard to say without getting into the actual situation of, what your goals are, what your lifestyle is used to living, and things like that. So if you use, if you have $1 million portfolio and a $50,000 pension, then yeah, again, the $1 million, you're still only going to want to pull in that 4 to 5 range, just because you don't want to run that to zero. Some people will pull higher because they're not worried about leaving anything for the kids or anything like that. So we have some clients that'll pull 6 or 7% a year. So as far as how much you're going to pull out, it all comes down to your lifestyle. Because again, maybe you don't need more than 60 or 70,000. So in that case, you would get 50,000 from your pension and then only have to pull 20,000 off of your IRA. So the nice thing about 401ks and IRAs is they continue to grow tax deferred. So you're not paying taxes on all that growth as the money's growing. You only pay tax as you pull it out. So pulling extra money out and just sticking it in a savings account if you don't need it is not necessarily the best thing, because you could just be paying taxes on money that you don't really need to be paying taxes on quite yet. No more questions right now?
I think we're caught up.
Okay, good. Okay, so we will get into strategies for retirement living. So this gets into asset allocation. So this is by far the biggest factor in your overall return in your portfolio over a number of years is what kind of asset allocation you're invested in. So this has the 3 major asset classes that most of you are familiar with. So you'll see cash down there is the green line. So think of cash as, CDs, money markets. They use a 30-day treasury bill in this example. So as you guys know, those cash money markets don't tend to pay much as far as interest goes. Cash tends to lag inflation. So historically, inflation averages around 3% a year. It's very rare that you get 3% a year in a savings account or anything like that. Now, many of you will say, oh, but we did back in the 80s. You're right, you did. You were getting CDs that were paying 15% and things like that. But inflation was running much higher back then too. So interest rates tend to be relative with inflation, which is why we're in a super low interest rate environment right now, which is why your savings account isn't paying very much and things like that. The next step up, kind of cash is very low risk, right? CDs don't tend to lose value or anything like that. The only real risk to cash is inflation, because it just won't keep up with it. So then if you kind of go up to the next line on the kind of risk spectrum, if you will, is bonds. So bonds there's a number of types of bonds, right? So many people are familiar with, just government savings bonds. That's not really what we're talking about in this scenario. These are more either corporate bonds or U.S. government treasury, like 20-year, 30-year notes, things like that. So bonds, again, historically are less volatile than stocks, but being less volatile means that they tend to not return quite as much as stocks do. Now, there are certain periods throughout time where bonds do really, really well. We're actually just coming out of a really good period for bonds. So if you think of what interest rates have done, interest rates have come way down over the last 20, 30 years. So the last 20 or 30 years has been a good time to be in bonds because they're actually paying pretty decent interest rates. But even with that, you'll see they go back from 1996 to 2015. So what is that, 20 years of investments. Even with the good bond environment in that scenario, stocks still outpaced bonds in that scenario. So stocks, of course, historically have a little higher long range return, but that's again because they tend to be more volatile. So many of you remember, 2008 was the last big crash we had, 2008 into 2009, where the market dropped 55%. So you see it on that red line, kind of where it bottoms out there. That was the worst correction we've had since the Depression. And then if you go back further on this kind of line here, you'll see back around 2001, 2002, that's when we had the dot-com bust. So with stocks, they do have, peaks and valleys throughout time, but over time, your long range return is going to be a little bit better in stocks. And that's again, because there tends to be more risk. So we all want to make as much money as we can and not lose anything, right? Unfortunately, that's not how it works. To get some returns, we got to take a little bit of risk, but the trick is to keep your risk within a tolerable level and still get a decent return of what can accomplish your goals for you.
I have a couple questions here, Kyle. Okay. I'll briefly take the first one, but I'm giving you the second one. So the first one, can you speak to the advantage or disadvantage of Roth versus traditional IRAs or 401ks and who should do which? So it's a very individual decision based on your earnings and things like that. But your rule of thumb is when you think Roth, you think either younger people or lower earnings versus the potential to earn more later. So when you're putting into Roth 401ks, what you're doing is you're paying the tax now. So if you're in your 20s and 30s and maybe your tax bracket is 10 to 15%, you're paying that tax now on your money, and then you're putting it into a Roth where later on in life, as you're earning higher, maybe you're in the 25 or 30% bracket, you don't want to be paying the tax for a Roth at that rate. You'd rather take the tax deferral by waiting then to pull that money back out later. So when you go to retire, if you have a Roth, if your income tax is higher at that point in time, then you will have wanted to have a Roth because the tax that comes out of it will be light. There won't be any tax at that point. So it really depends. It's just kind of a play on how your taxes are going to fall. You can guesstimate how much you make now versus what your thought process is that you'll be making in the future or into retirement. Obviously, if you have pensions and your retirement income is going to be quite high as well, having a Roth at that point would have been an advantage. Mm-hmm. So it really depends on your earnings at that point.
And one more point on that, Melissa.
Yeah.
People tend to think of 401ks or IRAs as investment vehicles. They're actually not. They're actually more of a tax vehicle than anything. So as Melissa was saying, if you're doing a Roth, that typically is better for people that are in lower income tax brackets now than they will be in the future. Obviously, the caveat to that is we don't know what income tax brackets will be at in the future. So it's kind of a way to hedge what you're looking at. So like Melissa said, rule of thumb, younger people in lower income tax brackets tend to benefit more from a Roth. But we can flip it too, whereas if your retirement income is going to be the same or higher than what you're making now, or not even your income, if we assume that the tax brackets are going to be higher in the future than they are now, then you may actually be better off doing a Roth now. But it all comes down to what tax bracket you're in now versus what we think you're going to be in the future.
So your next question, Kyle. I'm sure everybody's wanting to hear this one. I'm also interested in how you view the effect of the state tax initiative we will be voting on soon. If that passes, how will that affect retirement planning in Illinois if Illinois starts taxing retirement benefits?
That's a great question, and unfortunately, none of us have the crystal ball. It will definitely have an impact, though. I can guarantee you that. So right now, the state of Illinois does not tax retirement dollars. So what that means is any money coming out of IRAs, anything in pension dollars that you get on an annual basis, anything like that, you do not pay state of Illinois income tax on at this point. It's one of the few things that Illinois has going for it when it comes to retirement. However, they are talking about changing this. It will have an impact because it will slightly raise, obviously, your tax liability. We've kind of been joking with clients about this for a number of years, that it was probably only a matter of time before they started talking about this, because it was low-hanging fruit, I like to say. It was something that they could change pretty easily and not ruffle too many feathers as far as that goes. So if it passes, it will definitely change retirement planning, but it's going to depend on what that tax rate is, right? I mean, the state of Wisconsin, just across the border, taxes retirement dollars, but it's at a fairly low rate. Even, a state like Arizona taxes retirement dollars, but people still love to retire there. Well, their state income tax is only like 2.5%, I think 3%, something like that. So it's still very manageable. So it really depends on what that rate is going to come up to. And then we'll see how that plays out. So sorry, I can't give you a direct answer, but we don't know how it's going to play out quite yet.
Another question, when your colleague said that a 75 to 80-year-old couple's expenses will be much less, what about healthcare and long-term care expense impact, how people manage to pay for Medicare parts plus very expensive long-term care? That really, so when they say a 75 to 80-year-old couple will be less, it's hypothetical. So usually when you're 75 or 80, you likely don't have your mortgage anymore. That's usually a big monthly payment that's there. Those have usually paid off. You might have a free and clear car. You don't have a car payment anymore. If you're retired, you're not paying into your FICA out of your paycheck. You're not contributing to your 401k. So the overall amount that you're spending is generally lower. In the Midwest, you can usually retire on $3,000 to $4,000 a month and be fine if you live just a regular middle class lifestyle. However, you are correct. Medicare costs are there in long-term care. Medicare for the average person is about $144 a month that comes out of your Social Security. And then you do have the other plans on top of that, it just depends on the plan that you get. And as far as long-term care, it depends on if you have long-term care insurance, depends on how that weighs to your portfolio. We always recommend that you get a quote. It's important to at least get it quoted to see, is it feasible to pay the cost of long-term care versus the size of your portfolio. If your portfolio is not very large, then it doesn't necessarily make sense, because you'll end up spending it down and going on state pay for long-term care at that point anyway. So there won't be a whole lot of out of pocket. It really just depends. If your portfolio is bigger, you're going to have to pay out of pocket, and then yes, that can get expensive. Mm-hmm. Kyle, any follow-up to that? Or
yeah, so Medicare is probably going to be the best insurance you've ever gotten. So as Melissa said, for most people, the cost of Medicare Part B is actually based on your income. Most people, it's around $144 a month. If you make a significant amount of money in retirement, it's slightly higher than that, things like that. So that covers so Medicare has two parts through the government. So you have Part A, which is free. Everybody that's, I shouldn't say almost everybody qualifies for Medicare Part A, unless you're, a non-citizen and didn't work in the U.S., things like that is where you would not qualify for Part A. But almost everybody that's lived in the U.S. qualifies for Medicare Part A. That actually does not have a cost to you. So Part A is free. So when we're talking about that $144 a month that comes out of Social Security once you turn it on, that is for your Part B. So Part A and Part B is what comes from the government. Part A and Part B combined cover about 80% of your medical expenses. They do not cover, though, dental, vision, and hearing, which is one of the big things that, people get a little ticked about, because that tends to be what goes as you get older, and that's what you need to help with, is the dental and vision and things like that. So Part A and Part B covers about 80%. Then you'll either get a Medicare supplement or a Medicare Advantage plan. So right now we're in the Medicare open enrollment period. So that's why there's so many commercials right now about zero copay Medicare Advantage plans and this and that. So depending on which route you go, Medicare Advantage plans can be very reasonable monthly premium wise, but they do have networks, they have copays, they have out-of-pocket costs. So you want to be careful when you go with that. Like I said, we don't sell insurance. We have insurance agents that we can refer people to, and we'd be happy to have a conversation with you about it as well. If you go the Medicare supplement route, depending on which plan you pick, it's going to run you, somewhere around $120 to $150 a month. But that will cover just about 100% of what that 100% of that 20% that Medicare doesn't cover. So essentially, if you go a supplement route with a Plan G is what it's called, you have a small deductible of around $150 a year, but essentially everything is covered after you pay that $150 a year. So for roughly, if you figure 144 for Medicare Part B, $150 for a supplement, we'll say you're at about $300 a month, and you'll have essentially no copays, no deductibles, go to any hospital you want, things like that. So typically Medicare isn't a huge cost for people. It is the long-term care, like you said. So long-term care can get very expensive for those of you that have, family members or friends that have been in a long-term care facility. It's absolutely nothing for them to run, $70, $80, $100,000, even in this area in Rockford here. So it can get very, very expensive. However, there's kind of like Melissa said, I call it a danger zone of what your portfolio is worth if long-term care makes sense for you. So for those of you, let's say your portfolio is $200,000, a husband and a wife. Well, if the husband goes into a nursing home, they cannot impoverish the spouse. So if your portfolio is worth $200,000, obviously you go into a Medicare or a long-term care facility, you're going to have to pay that, but they have to leave the spouse with a certain number of assets. It's around $125,000 a year. Don't quote me on that, but it's somewhere in that range. $125,000 in total assets, one house and one car. So it's not like if husband goes into the nursing home that, the spouse is put out on the street with nothing. So again, that's why I say if you've only got, 200,000, yeah, maybe we have to pay it for a year before we get spent down, and then you get onto Medicaid. On the other end of the spectrum, if your portfolio is worth, let's say, $2 million, and you can earn, 5% interest on that portfolio, well, that's about $100,000 a year just in interest that you're making on that portfolio. So even if, husband goes into the nursing home, the first thing they have to do obviously is Social Security, pensions, those types of things. But then you've also got this portfolio of $100,000 a year interest. So the chances of you getting spent out of $2 million at, roughly, maybe they have to take $10,000 a year off the portfolio or something like that to cover it after Social Security and pensions and that kind of stuff. You're probably not going to run out of money if your portfolio is that big. So, the people that we say should look at it is if your portfolio is somewhere in that 500,000 to, $1.5 million, $2 million range, that's probably where it makes sense to take a look at it and see. But they can get extremely expensive, guys. We have clients that are paying, tens of thousands of dollars for long-term care policies that they've had for a long time. And at some point you can kind of get stuck where you just got to kind of pay it because you're so far into it now that if you need it, it's there for you. So it's one of those things, again, so much that we talk about here is really individual based on your individual situation. But they are great questions to have. Any other ones, or are we caught up again?
It looks
okay.
Looks like we're good.
Man, we don't get this many questions in person. You guys must like the webinar. So, so back to the portfolio. So rebalancing your portfolio is extremely important. So in this case, if you were to start your portfolio at 40% stock and 60% bonds back in 1995, and you did not touch that for 10 years or 20 years to 2015, you can see that your portfolio essentially is now at 50% stock and 50% bonds. Now, why is that important? Well, you just changed your risk tolerance because you just added 10% in stocks. So your portfolio is now going to be a little more volatile. And if we go through a big correction right before you retire, that can definitely have an impact on it. So you definitely want to take a look at rebalancing your portfolio at least annually, but probably even, every 6 months or so. It just depends on what the market's doing as far as are stocks really ripping up or, is the bond market doing well? Because these things can get out of whack. Nowadays, they also have, for people that want absolutely nothing to do with their 401k, they just want to put money in and not think about it. They do have what they call like age-based funds and things like that. So you essentially pick a year of when you think you're going to retire. And then there's a manager behind the scenes that's automatically making tweaks for you as you go along. So, don't set your portfolio when you're 21 years old, putting money in and then just not touch it again until you're 65. That's just not, you could lead yourself to some hurt. So, our founder actually had a great story about this. There was a guy that came in back in 2008. about broke down in tears because, you know, they sat down, went through his portfolio, and he had $1 million. And our founder was like, "You did great. You've got $1 million here. What are you so upset about?" And he said, "Before 2008, I had $2 million. So because he was too aggressive right before he was ready to retire, he lost about 50% of his portfolio." So as we're talking, you know, 5% of 2 million is a lot different than 5% of 1 million as far as income goes and things like that. So that's just where you want to be planning for this stuff, guys. As we get closer to retirement, generally people should be getting a little less aggressive. You know, you don't want to be 100% stock all the way up until 63, 64 years old, because we just never know when the bottom's going to fall out. And if it does it right before you're going to retire, it can actually cause people to have to work for a couple more years to help make some of that money back up. So, okay. And then where is your money right now? So this has to do with your overall picture of where your money is. So when we say where is your money right now, we're talking about everything. We're talking about your 401k. We're talking about your cash and savings at the bank for your rainy day fund. We're talking about college savings plans for the kids and all that kind of thing. So when you're planning for retirement, we want to make sure that everything is working towards your goal. So what I mean by that is if you have, you know, let's say you only have $200,000 in your 401k and it's 100% stock, but you're big on saving after tax and your savings account has $200,000 just sitting in cash, right? Well, now, you know, what are we trying to accomplish? Are we trying to make a good return and put some money away, or are we, you know, really concerned about the market and want to stay in cash? And how many people have old 401ks from employers that they haven't touched in 20 years? They didn't roll them into their new employer or anything like that, and they can get lost in the shuffle. So we have a number of people that say, "Oh yeah, I got this letter in the mail because I turned 65 and it's from a job that I had 30 years ago, and they're asking me if I want to turn my pension on that I didn't even realize I had, or my old 401k is still sitting there." So it's very important as you move through life and as you change jobs and make tweaks, you want to try and consolidate things as much as you can. So, you know, we don't want clients that have, you know, 10 IRAs all over the place, because as you get a little bit older, your faculties tend to slip a little bit and it's real easy for things to get lost. And even if you're sharp all the way up until you pass away, your kids don't want to go through the paperwork of trying to figure out what's still good and what's not good and what's 30 years old and things like that. So that's the other side of it. So we want to make sure everything is working together to accomplish your goals. Good. Okay, so distributions from retirement plans. So we've talked a little bit about safe withdrawal rates and things like that. But I'll also talk a little bit about the Secure Act and the CARES Act. Those are two big legislations that have been passed in the last basically year and a half here. So with the distributions, many people are familiar with something called a required minimum distribution or a minimum required distribution, RMD or MRD. It's pretty much the same thing. So that age that people are familiar with used to be 70 and a half. So up until earlier this spring, you had to start taking required minimum distributions at age 70 and a half. They have since moved that age back to 72. So if you've got money in an IRA or a 401k and you don't need it, you can let it sit until 72 now and not have to take any money out. But once you turn 72, that's when the government essentially steps in and says, okay, we've let you have this money grow long enough, tax deferred. We want some of our tax dollars out of it. So they start forcing out a little bit of money to you each year. There's a divisor table based on life expectancy. It's based on your account value as far as how much you have to take out. But in the first year at 72, it's right around 4%, and it actually increases a little bit each year. So it goes from like 4% to 4.2%, so on and so forth. So it does raise a little bit. So while that sounds great, they let it grow for 2 more years. Where they're going to get their tax money from is from your beneficiaries, because they let it sit for 2 more years. But beneficiaries, so if you pass away and leave your money to the kids or grandkids, whoever you want to leave it to, they used to be able to stretch it over their lifetime, which means they had a required minimum distribution, but it was based on their life expectancy, not yours. So if you pass away at 80, you pass it on to your kid that's 60, they get to stretch it out for their, you know, longer time frame. However, that changed now, and now all beneficiaries have to have it out within 10 years. So if you think about that, if mom and dad pass away and they've got $2 million in IRAs and they've got one child that has to have this money go to, that child only has up to 10 years to pull the money out. So that can be a huge tax burden, because remember, this is all income taxable. So in that scenario where you've got one beneficiary getting 2 million bucks, even if they spread it out equally over 10 years, that's roughly $200,000 a year of taxable income that they would have to pay tax on. So that's one huge change that came across here, like I said, just earlier this year. Anything to add there, Melissa?
No, other than that's, times like that, that's where planning really comes in. We've seen that, a few of the beneficiaries, if they're 63, they retired early, but they're on Affordable Care Act insurance, that may not be the time to start pulling out those funds. It has to be out in 10 years, but it doesn't have to be all, throughout the 10 years. You could do it all at the end. So it's really important to kind of plan for that, to say, okay, in 6 years, I'm going to be retired on Social Security. I'm on Medicare at that point. My needs aren't as big, or a large income amount may not change my expenses. So then maybe the time to start drawing that, versus doing it now. And then all of a sudden you have a large taxable income that hits you and you're paying into Affordable Care Act subsidy reimbursement. So just planning properly for that is going to be really important.
Mm-hmm. Okay. So the other thing that we can touch on here is we can touch a little bit on estate planning. So many people are familiar with estate planning and wills and trusts and things like that. So many people, want to know what the difference is between a will and a trust. So at a minimum, everybody should at least have a will and powers of attorney set up. So what a will is, it's basically saying, what happens to all my stuff if I pass away? Now, any IRAs, 401ks, life insurance policies, bank accounts, those are typically beneficiary driven, which means no matter what your will says, those accounts, those types of accounts are going to go to the beneficiaries that you've named on those accounts. So a will is more for your personal belongings and things like that. In a perfect world, we like to joke that all of our clients would have a trust because it gives you more control over how your assets are disposed of once you pass away. So with a trust, yes, they're more expensive to get set up and things like that, but you just have so much more control over how your money gets dispersed. So if you go the trust route, it's very, very, very important for especially people with blended families, or maybe families that have some discourse inside of them, things like that, because a trust will absolutely spell out who gets what and how they get it. So in a trust, for instance, you can say that, yep, my $1 million IRA goes to my kids, but they cannot get the full lump sum at any period. They have to take out, just the minimum. So they can only take out a certain percentage per year and things like that. And it also can say, yep, we'll buy, the grandson a new car, we'll help for his schooling, but we're not buying him a Porsche. He's getting a reasonable mid-sized sedan and things like that. Trusts also protect from creditors and even, spouses or future ex-spouses. God forbid, you pass away, leave your, let's say you leave your daughter $500,000, and a month after you pass away and she gets that money, her husband decides to file for divorce. Well, if she's commingled that becomes marital property, and that can be a mess. And that's probably not what you had in mind for your daughter. So that's, again, where a trust can come in and just give you a ton more control over the income. Good. Any other questions I've seen?
Yes. Could you talk about dividend income and what a retirer could expect to invest in? If a company pays 2 to 3% dividend, why wouldn't you invest in that stock just for the dividend money?
That's a great question.
That's a great question. I like that one.
Yeah. So dividends are great. There's a lot of people that invest in dividend paying stocks, typically your blue chip stocks, things like that. People invest in them for their dividend potential, because you're absolutely right. Many companies can pay 2, 3, 4% dividends, which are great. The downside to a dividend is they can go away, and they can go away very quickly. The company can essentially say, we're not going to pay a dividend this quarter, and there goes your dividend income. And again, you're talking about dividends would be 100% stock. So yes, typically companies that are paying good dividends, your blue chips like we're talking about, aren't as volatile as maybe some small caps or some tech companies or anything like that, but they are still more volatile than the overall stock market, right? So anytime you own one company, this gets into something called diversification that many people have heard about, right? So if you own one company, the chances that that company can go up by 10% or, down 10% in a matter of a couple days or a week is not unheard of. Now, again, typically your higher dividend paying, your blue chip dividend aristocrats, some people call some companies, those tend to not be quite as volatile because they're more well-established companies, but there is absolutely some more risk in those. And it's interesting too, if you were to look at the history of like the Dow Jones 30, for instance, which tends to be the 30 companies in the US. If you were to look at that over the last 20 years and how many times those companies have changed, it's actually pretty interesting. I mean, Sears is a perfect example of one that's kind of went belly up in the last couple of years, whereas 30 years ago, everybody loved Sears and it was one of the biggest retailers in the nation. So dividends are great, but there is still some inherent risk anytime you're in one individual company stock. So good. Okay. Anything else? Let me double check that we haven't touched on here. We talked a little bit about pensions and 401ks. They are different. So typically a pension is an employer plan. So pensions are great. They pay, again, as long as the company stays solvent, they pay a nice monthly income stream for most people. But like I said, they are going away. And there's many companies that are actually trying to get them off of their books. So over the past few years, we've had a number of companies offer lump sum buyouts for people with pensions because they want to, again, get them off of their books. So pensions tend to be a monthly income stream for most people. If you have a pension, typically you're going to be asked if you want it to pass on to any spouses, if they want to get 50% of what you're drawing or 75% or even 100% of what you're drawing, that can all play into it. So if you have a pension, it's important to look at all your options, probably with a professional, because sometimes the nuances of, what happens if you pass away can be a little hard to grasp and understand. Especially those of you that have worked over at Collins for 30 plus years, you have multiple pieces of a pension, and they all have different values and different options for each little piece. So there's a lot of things that come with pensions too. Okay. Any other questions? I think if you guys want to type into the Q&A, or if you just have a question you want to ask, you can do that. It looks like most of you are on mute. So if you want to ask a question, you'll have to unmute yourself, but I think we can open it up a little bit here.
Okay, so here's an interesting one. Kyle, I don't know if you've got any reference to this. So someone's asking books, magazines, or websites to do some homework to understand trusts in general and be able to discuss intelligently.
Yeah, that's a great question. Trusts can be very complex. So there's multiple different types of trusts, all kinds of things like that. So books, magazines, I'm not really sure where you would find as far as specific things as far as that goes. I know like certain law firms and stuff like that will put out white papers on trusts and things like that. I'm not sure. I would maybe even the American Bar Association. I don't know if they do anything for attorneys or something like that they would put stuff like that out. But yeah, it's a great question. Unfortunately, they're just so custom, and you can, pretty much you can do just about anything you want inside a trust. So there's some general things that you could definitely look at, but it's going to be so much on, your individual situation and things like that. But that's a great question.
Yeah, and there's so many different kinds of trusts too, between revocable or irrevocable or special needs trusts. It really depends on, like Kyle said, your certain situation and special needs that you may have. And a lot of the estate planning attorneys, when you're looking at trusts, our recommendation is definitely to sit down with an attorney that specializes in estate planning. Any attorney probably could write a trust, but having an attorney that is up to date on the estate planning laws that can change every year is important. A lot of them will offer a free consultation right at the beginning, just to sit down and say, what does it look like? What does it mean? And, are there questions that they can answer for you as you're looking at getting prepared towards that?
Great. Oh, I like the next question.
Did you, I was going to say, did you see what just pop up there?
Great question. Great question. Thank you, Frank. This is a good one. Is Klaas a fiduciary? Yes, we are. So we actually just went through a major internal process where we're still a fee-based retirement planning firm, but we are pretty much fee only at this point. We have a few products that still pay us directly from the companies, but that's actually gone away now. So I'm going to expand on this a little bit, Frank. So the two questions you should always ask a financial advisor is how do you get paid and are you a fiduciary? So what a fiduciary is it means that your advisor, if he's acting in a fiduciary capacity, he has to act in your best interest as the client. So while this is a big thing right now, you guys might remember, it's been 2 years now, I think, the Department of Labor proposed something called the fiduciary standard. So this gets a little bit into the industry. So in the old days, you had stock brokers, and they were generally Series 7 licensed. So a stock broker was a representative for a broker dealer, which means they had to act in the best interest of the broker dealer, not necessarily you as the client. They had to make a suitable recommendation to you. So a good analogy I've heard of this is going to get fitted for a suit. So if you just go into a store and say, I want a suit, they can give you a suit, but that doesn't mean that it's going to fit. So just because it's a suit means it might be suitable because you asked for a suit, but does it fit you personally? Is it what you were looking for? That's kind of where the fiduciary comes in. So you should always ask a financial advisor if they're a fiduciary. Again, the big meaning of it is that they have to be acting in your best interest. So why we made this change internally was because now the only way we get paid is directly from our clients and the fees we charge them. We do not get paid from, a mutual fund company or an ETF company that we're representing their products. So that's a great, great question. And like I said, you should ask every financial advisor that. And I told a friend of mine that, and because her mom's up in Minnesota or something like that, and she went into an insurance broker's office to talk about her retirement plan. And I prime all my friends. I said, anytime you talk to an advisor, if it's not me, you should ask them, are you a fiduciary and how do you get paid? Well, she asked this guy how he got paid and he wouldn't give her a straight answer. So that should tell you about what you need to know is if they won't answer that straight. So great question, Frank.
I like to tell my clients when they ask about this that there's nothing that I can tell you or sell you that will make my individual paycheck any bigger. So, you can rest assured that when I'm telling you something, it's because I solely feel that as an advisor, it is in your best interest. It's what I feel you should do or the advice I should be giving you, not because there's any kind of a commissions or kickbacks or any benefit behind the scenes, which is why a fiduciary is so important.
Good.
I think we've caught up with all the questions. There was great questions tonight. I like
There was, yeah. People are a little more apt to type them in than ask them out loud, I guess, apparently. I guess we could touch base a little bit on health insurance, guys. So we talked a little bit about healthcare in general, but for many people, that's the biggest factor of when they can retire. Because if you retire before 65, so I talked a little bit about Medicare being eligible at 65. If you retire before 65, you have to get health insurance typically. I mean, it's not wise to go without health insurance. So your options are most likely going to be either the Affordable Care Act or Obamacare, as people call it sometimes, or maybe you're fortunate enough to have employer coverage if you've been there a long time and they offer that to their retirees, or some people are veterans, so you can get veterans insurance, things like that. So how the Affordable Care Act works, though, it's called the Affordable Care Act, and we kind of chuckle because it's still very, very expensive. So we have clients that are coming in, they've saved well, they're in a good spot to retire, but then they go look at health insurance costs and they're, let's say they're 63 years old for a couple. They can easily be spending $25,000 a year in health insurance premiums. And then God forbid they use it and have to pay their deductible of another, $6,000, $7,000. So they can be into their health insurance for $25,000, $30,000 pretty easily. And for many people, it's not even, oh, can I afford it? If you've saved well, you probably can afford it, but it's, do you want to pay that, right? So now not only are you working for your salary, but you're also saving yourself $25,000, $30,000 a year in health insurance costs. So for some people, that's kind of a caveat to keep them working and things like that too. Did we get another question pop in?
I got one that we're going back and forth a little bit on an individual situation.
Okay.
I think I'm caught up.
Good. Like I said, if anybody has any questions they want to ask out loud, I think we can do that now. Like I said, most of you are on retirement, so it will be, or on mute, I'm sorry, so you'd have to unmute yourself.
Let's see if one is not working.
All right. Thank you for joining us, Steve and Jill. I just seen your chat message over there. Thanks for joining us. Well, good. If we don't have any other questions, I think we can wrap this up. Give you guys a minute or two here. Awesome. Good. Okay. All right. Well, if there's no other questions, guys, we will go ahead and wrap this up. We appreciate you all for joining us. Hopefully you learned a little bit. Like I said, we got out a little early, but we had so many great questions tonight. It was fun. We really enjoy educating people and helping you guys out with this kind of stuff. If you have any questions, don't be afraid to reach out to us. We'll be sending a follow-up email here in the next coming days. So it will have our email address, but you can also call our office as well. Look us up on our website. We do a radio show. I'm actually doing it tomorrow morning. We do a radio show every Thursday morning in Madison, and we actually post the podcast onto our website as well. So we get through a little more detail of all these kind of questions that we touched on tonight. So if you're looking for more info, definitely check out our website as well. So, all right. Well, thanks everyone. Look forward to catching up with you guys soon.
Thanks, guys.